Welcome back to Cracking the 401k, your one-stop journey through the twists and turns of your retirement plan. In our last episode, we navigated the rugged terrain of hardship withdrawals. And today, we reach a pivotal mile marker on the retirement highway, age 59 and half. That's right. The magical age when your 401k door starts to creak open, no penalties attached. So buckle up, because today, we're going beyond just age. We'll talk about the freedom to withdraw, the smart use of rollovers, and the final chapter. Distribution day. Let's dive in. The 59 and half gateway. Picture this, you're 59 and half, still working, still contributing to your 401k, but now the locks are off. You're now eligible for something called an in-service withdrawal. It's like getting the keys to a room you didn't know existed in your financial house. If your plan allows it, you can now access virtually all types of vested contributions. Before tax, Roth, 401k, employer matches, even rollovers. Earnings, yep, they're in the pot too. But here's where it gets interesting. The plan sponsor, aka your employer, gets to set the order in which these funds are withdrawn. We call this the withdrawal hierarchy. A typical one might look like this: grandfathered after-tax contributions, non-grandfathered after-tax plus earnings, rollover money plus earnings, employer contributions, hardship, eligible employee before tax, and Roth 401k, and finally, your regular before tax and Roth 401k dollars that become fully available at age 59 and half. Now the biggest perk here, no 10% penalty tax. That's the IRS giving you a thumbs up for reaching retirement half-time. But unless you roll it over, expect a mandatory 20% federal tax withholding. You'll also receive a 1099-R form next January. So yes, you get freedom, but always read the fine print. Rollovers, taking your money on a road trip. Now let's say you've got your eyes on greener investment pastures, maybe a brokerage IRA with more options, or just better fees. That's where in-service rollovers come in. Instead of taking a cash withdrawal, you can roll your funds over to another employer's 401k plan, a traditional IRA. Or if you're feeling adventurous, a Roth IRA, though keep in mind, that's a taxable move. This is especially appealing if you want access to professional advice, a different investment strategy, or just want to consolidate multiple accounts. The best part? No taxes or penalties on rollovers as long as they're done correctly. It's like moving houses without paying a moving fee if you plan it right. Withdrawal mechanics. It's not just click and go. Requesting a withdrawal isn't like hitting an ATM. You'll likely need to choose the type of withdrawal, enter the amount, percentage or dollars, decide if you want a rollover for any portion, and here's a cool feature, some plans offer a gross-up option. Now what's that? Imagine you need exactly $1,000 in your hand, but taxes eat away 20%, right? Without gross-up, you'd only see $800. But if your plan allows it, the system can gross up your request to about $250. So after taxes, you still walk away with $1,000. Neat, right? Also note, withdrawals are often processed daily, but cut-off times and check delivery can vary. Some plans process once a week, even if they value accounts daily. Patience matters here. The final distribution, your retirement exit ramp. Eventually, the time comes when you're no longer with the company. Maybe you're retired, disabled, or simply moving on. That's when you become eligible for what's called a final distribution, the big cash out or transition of your 401k. Here are your options. Take a lump sum. Just be ready for the taxman and possible penalties if you're under 59 and half. Roll over the balance. Keep the tax-advantaged status by moving funds to another retirement account. Installments. Think of it like your own custom pension. 10 annual payments, 20. It's up to your plan's rules. Annuities. Rare, but possible. This turns your balance into a series of lifelong payments. Leave it in the plan. If your balance is above a certain threshold, you might just sit tight and let it grow. But be careful of small accounts. If your balance is below $1,000, you might be cashed out automatically. Between $1,000 and $5,000, the plan may roll you over to a default IRA. Always read those plan emails. Silence can lead to automatic decisions. Closing thoughts. Decisions that define retirement. 59.5 is more than a number, it's a pivot point. You get access, flexibility, and choices, but with freedom comes responsibility. Understanding taxation, timing, and strategy can make the difference between early empowerment and regret at tax time. And final distribution, that's the true finale, the moment your 401k steps aside and your retirement begins in full. In our next episode, we'll explore the world of loans, required minimum distributions, and that often misunderstood concept, involuntary cash-outs. And don't forget to subscribe for more episodes where we break down money topics that matter to you. Remember, this content is for educational purposes only. For the most up-to-date rules and changes, always check the official IRS or Department of Labor websites.